have a topic focus for this webinar. It's about how much should I raise in a series A or B? And I'm going to start with you, Kai. Let's say we went to product market fit. We have a sales team, we have a product that is scaling, but now we also need some money. So what is the range of funds that scale up teams typically raise in a series A? I think you have a few cents to add to this with your own experience.
Sure. And I think it's just very important to step back, kind of reflect on what does a Series A really mean for a second. And what it principally means is it's a class A of shares that go on top of the common shares, right? The same for the B and the C and so forth, right? And what that means is you often have preference shares that go on top of the common shares, what the founders and initial team would have. Maybe angels also have. Um, uh, and in that class A of shares, you bring on new investors, and typically they come with additional rights, right? So there's things like liquidation preferences, which is kind of a more standard term, and there's many other different terms that you can put on top of it. But it's a separate share class that comes across on top that has different control rights, and the range of funds can vary immensely, right? You can do a Series A after bootstrapping for a decade or two. There is then kind of the standard startup journey that's kind of evolved and emerged, where there's kind of the standard Series A, which also has wide ranges of 5 to maybe 20 million, I guess, is kind of the range that one could say now. There's also what you also have to differentiate a little bit is what people put into the media, which is often it's aggregate rounds and somehow they call it a Series A. But I think the first interpretation is really important. It's kind of a class A of shares that come on top that you raise a significant amount of funds with, to kind of take that next step.
I like that because that's super important when you eventually make it to an exit. These shares usually get paid back or paid out first, right? That's a very important part to keep in mind for founders.
Yeah, I mean the range of different terms that are attached to them are incredibly varied. But if you look at kind of the most standard terms, the first one that usually comes into it is a 1x non-preferential liquidation preference, um, and sorry, non-participating liquidation preference. And what that just means is that they get their money back initially, and then the proceeds are then distributed again based on the shareholdings. But there's so many other terms that one should be familiar with before one goes into that. It's good to read the standard publications about that.
Frederick, when it comes to raising a Series A or also Series B, you always want to get some money in your company to extend your runway and to be able to finance your operations and additional investments. How much runway should we aim for? Usually in the early stages, you say 12, maybe 24 months. Is that the same? Is it more? Is it less for Series A or Series B?
Well, as Kai also said, I think it really depends on the company. So I think what I always also talk to other founders about is before assessing your runway for a specific round, you kind of need to take a step back and really understand what's the dynamic of your company. How much cash will the company ultimately need to become profitable? Is it a pretty light company? Is it just one round and then you're through? Is it deep tech, for example, like antibiotics, and you'll need several rounds? That really changes the dynamic of that question, because either it's kind of a pretty we need one round and 1 year or 3 years or 4 years, and then we're through, and the dynamics of the fundraising won't fundamentally change. Or you understand, for example, Series A, you're still pre-product market fit. If you're tough on the term product market fit in deep tech often, right? So then you really need to be very, very conscious around the milestones that you need to achieve until you go out funding for the next time. So step one, assessing, what is ultimately the funding need that I believe I have today for the company in the long term, and then break it down into rounds and milestones that you need to achieve. So typically when you then think about those milestones and the inflection points down the road, it is, as you say, typically 12 to 24 months. Why is it 12 to 24 months? Because below 12 months, the risk of not achieving something and having a very short breath is just too high. Above 24 months, it is often then a question: hey, why do you raise so much today at a lower valuation if you will reach inflection points in the next 24 months to then raise at a higher valuation, have less dilution? Um, so it's typically, I would say, the 12 to 24 months plus a certain buffer, right? To make sure that you actually can reach that inflection point, because reaching then the next inflection points, having your company at a next stage, makes fundraising massively easier in subsequent rounds compared to, just having to tell the same story with an only slightly different twist over again.
I have a follow-up question about the buffer that you just mentioned. Often you come up with a very detailed budget and say, this is what we're going to do with the money. These are the milestones that we try to achieve in these 12 to 24 months. And then there's this buffer. How big should this buffer be? Do you just add it as a percentage on top of your budget, or how does that work? Because sometimes I feel that can be difficult to explain to the investors what you want to add this buffer for in the budget.
Yeah, so I would less think of it as a buffer in cash. I would think of it more as a buffer in time between inflection point, materializing, and start of the next fundraise. So it's not just okay, and I want to raise 5 million on top of that. That doesn't fly. You're right. It's rather, look, I believe in summer next year we have a fundamental inflection point of the company, and that's in nine months from now. However, I want to make sure that I don't need to go fundraising next year already, just to make sure that we can either capitalize on that next inflection point, or have a buffer if that inflection point comes later, that I only need to go fundraising again, let's say in Q1 or Q2 2026. I would think of it a bit more like that. And then there's also the market perspective. Ultimately, it's not only in your hands how much buffer and how much runway you can create, right? It's ultimately also the excitement around your deal, and that also informs kind of your runway and your burn then ultimately.
I like that. It's more about extending the runway a little bit than just a percentage on top of it. Fantastic.
And I agree with that point around this huge amount of signaling value in terms of what you look for when you fundraise, right? Because that's always one of the things is what is your key ask? And what that typically signals is, people assume that with each round you take 20-ish percentage of dilution, right? It can range, again, those things vary quite a lot. But when you come out and say you're looking for 10 million, that means they'll assume you're looking to do that at a 50 million-ish post-money valuation, and they'll do that math backwards in terms of before they ever start discussing an actual valuation with you. So you're doing a lot of signaling with your ask already in terms of what the valuation will be, and it's important to think about that too. And then once you've reached where you have term sheets, then the dynamic completely changes, right? So at that point, you can then start discussing very different plans again. Once you have enough interest for the deal, because once it's funded, people are also usually very happy to overfund the deal. There's then the question of how much dilution you want to take.